If you are looking at your portfolio in 2026 and feeling like every move is a trap, you are not alone. Many first-time buyers and retail investors are currently sitting on their hands, waiting for a 2008-style housing or stock market crash to reset prices. The data suggests a different reality, a year defined by structural volatility and rising stealth costs that outpace standard inflation. Because of these shifts, pulling your money into cash to wait it out is not a neutral position. It carries a compounding cost that steadily erodes your purchasing power while you sit on the sidelines. For the public stock market, the baseline expectation this year is a sequence of sideways trading and frustrating shallow drawdowns. Historically, markets follow recognized rhythms. The Gann 60-year cycle points to a distinct period of heightened volatility aligning closely with the 2026 calendar year. Then we have to factor in the 4-year presidential cycle. Since 1950, year 2 of a presidential term, which is where we are now, has consistently delivered the weakest average returns. When we overlay the 60-year cycle and the presidential year 2 cycle, the historical rhythms align, suggesting a probable downward trough in the second and third quarters of 2026. Relying on passive, broad market index funds this year requires the psychological fortitude to endure this squeeze to capture the recovery anticipated for 2027. In the real estate market, many buyers are caught in a similar waiting game, staying out of the market to avoid elevated mortgage rates. But behind the scenes, persistent labor shortages and the rising cost of raw construction materials are placing a floor under home prices. At the same time, localized insurance spikes in high-demand states like Texas and Florida are inflating the true monthly cost of ownership. By waiting until 2028, you risk higher exposure to this stealth inflation. Your total monthly payment will likely be higher a few years from now, even if the raw sticker price of the house remains flat today. Navigating 2026 comes down to a choice for your capital, prioritizing liquidity versus preventing capital erosion. To weigh your options, we can plot them on this quadrant chart. We measure required effort and illiquidity on the x-axis against potential yield on the y-axis. Real estate plots right here, a bite-the-bullet strategy. Buying a home now means voluntarily sacrificing your immediate cash flow and absorbing a higher initial monthly payment. This is an illiquid defense mechanism. You are locking in baseline prices before the anticipated surge in demand between 2028 and 2030. If your goal is wealth preservation without buying property, you have to evaluate alternatives like private credit and base metal commodities. Private credit generates 8 to 8.5% yields that are structurally protected by senior secured debt. But the underwriting risk is specific. If a manager overlends to a software company disrupted by artificial intelligence, your capital becomes trapped at the top of a failing company. The alternative commodity play captures upside from clean energy supply constraints, focusing on base metals like copper and aluminum. Extracting steady yields from these alternatives requires completely surrendering the liquidity you would normally maintain in an S&P 500 fund. For the active optimizer, there is a final path: AI-driven narrative rotation trading models. These algorithmic systems promise short-term alpha, with some datasets recently showing isolated 37% weekly gains. But maintaining those yields requires treating the system like a full-time engineering job, managing API slippage, back-end updates, and state handling errors. There is also the risk of model overfitting. A feedback loop can start chasing market noise instead of true signals, triggering sudden drawdowns. AI trading is not a passive investment. It is a high-yield, high-effort job that sits on the extreme edge of our quadrant. So based on these overlapping market forces, where should you route your capital? Establish your first critical node. Do you need this money to remain liquid over the next 3 years? If yes, you hold cash or liquid stocks, while mentally preparing for the historically aligned volatility squeeze we discussed earlier. If no, you reach a second question. Are you prioritizing housing stability or pure ROI? If your goal is housing, you buy now. You trade a tight budget today to avoid being priced out by climate and insurance inflation by 2030. If you are prioritizing pure ROI, you hit a third node. Do you have the time to actively manage complex systems? If yes, you look at systematic AI trading. If no, you look at locking up capital in private credit and commodities. There is no universal right answer for 2026. There is only the right answer for your specific timeline and risk tolerance. 2026 is a transitionary year, characterized by structural shifts. It is not a year to chase hype or wait for economic miracles. Every financial choice you make right now requires sacrificing either your liquidity, your time, or your immediate cash flow. Define your personal timeline, accept the inherent trade-offs, and deploy your capital